Hello viewers, welcome to my YouTube channel, One Raj Kamal. This video is to capture the price market action that happened over 15th and 16th of June, that is Wednesday and Thursday this week, especially in the US markets. We all know that on Wednesday afternoon, the US Fed increased the Fed rate by almost 75 basis points. And that takes the Fed interest rate to between 150 to 175 basis points. This is the highest Fed rate hike since 1994. So going back 28 years, the highest Fed rate hike. And as we know, this is with a view to combating inflation. Now, what happened with this hike? Well, the price market action was very subdued in the hours after the rate hike announcement and the post announcement press conference. In fact, Wednesday market close wasn't dramatic. But the markets went down significantly on Thursday. The S&P 500 went down 3.25% on Thursday. Nasdaq went down over 4%. And the Dow Jones Index actually went down below 30,000 for the first time since September 2020. So quite significant drawdowns and pullbacks on Thursday. The question is, why did the market go down after such a large increase? There could be one argument that the large increase basically means that the cost of capital or the cost of borrowing in the market is going up. And that means valuations have to go down, and that actually brings down the price expectations of every stock. And the S&P 500 or the Nasdaq are an agglomeration of all the individual price expectations of all the constituents in those indices. Well, that may be true. However, we also need to always remember that the markets are forward-looking. Many of this is already priced in, or many of these factors are already priced in. And as we had discussed in the previous YouTube video, the expectation of a 75 basis points increase was already priced in as early as Monday, around the close of market on Monday. So why is it still going down? This basically seems to imply that the market expects further pressures from inflation. The market expects inflation to persist. There is still uncertainty, or probably the market does not have sufficient faith in the Fed. There is a question of credibility of the Fed, either in its capability to tackle inflation or in its intent to tackle inflation. I think that is probably a bigger factor. I was listening to the post-rate hike announcement conference that the Fed Chair Jay Powell was doing. And while he said all the right things, just the body language to me seemed less decisive and less clear than what I at least saw him doing in 2018 when the Fed was increasing rates every 3 months. And that was when there was no inflation. Here, there is runaway inflation, and yet, the body language doesn't seem as decisive. And I think that probably feeds into a question on the credibility of the Fed, which creates uncertainty for markets, and that is probably leading to further declines that we witnessed on Thursday. The other important piece of announcement was the GDP expectations that came out from the Atlanta Fed on 15th, and the Atlanta Fed has now revised the GDP growth expectations for the second quarter to 0%. Yes, 0%, and it has been going down. The Q1 GDP expectations were negative, and we all have talked about this earlier, that 2 successive quarters of negative GDP growth imply a recession. We're already in bear markets. All the 3 US major indices, S&P, Nasdaq, and Dow Jones, are in bear market territory. And now there is also a possibility of 2 successive quarters of negative GDP growth. So this could be a recessionary bear market as well. Now, it's interesting to note that bear markets can be both recessionary as well as non-recessionary. Since 2018, there have been about 25 bear markets, and only 14 of them were recessionary bear markets. 11 bear markets were non-recessionary. And that's the picture. So it's kind of mixed. It is, however, fair to say that recessionary bear markets have a history of sharper drawdowns, 39% versus 26% in non-recessionary bear markets. And also that the peak to trough in a recessionary bear market lasts longer, almost 390 days. Now we are probably 6 months into this current decline, peak to trough decline. And if this were to become a recessionary bear market, then the averages would imply that this pain would last longer because the average is about 390 days, which means over a year. Typically, a recessionary bear markets come along with increase in unemployment rates. So that means there are job loss announcements, companies cut employments. The weekly job claims that came out on Thursday was still low at around 225,000. But the 4-year continuing claims have increased, and they have been increasing now for the last few weeks. This is an early signal typically because a turnaround in the 4-year continuing claims typically signifies a change in market, where then it leads to potentially higher unemployment rates, and higher unemployment rates lead to fewer surplus disposable income with people in the US. The US is a consumer-driven economy, and that leads to potentially, tough economic conditions leading into recessions. Are these early signals meaningful? Is the US job market changing? Well, there are some early signals that there are job cut announcements that are looming. In the crypto world, Coinbase made an announcement earlier this week, but you could argue the crypto worlds are not representative. But in the broader tech world also, companies like Tesla, Spotify, PayPal, Carvana, etc. have also announced job cuts, and we have to watch out this space very carefully on how the unemployment picture in the US shapes up. What does the market look like going forward? Is there any rebound coming? Well, today the picture looks bleak. It's fair to say that. However, if you were to look at the S&P 500 5-year chart, you will see that there seems to be support around 3,600. We are already at around 3,666. So we are close to some early support that seems to be visible on the charts. There is also stronger support that seems to be between the 3,200 to 3,400 territory, but that's about 10% further down from the current levels. That's where support seems, and there could be bounces, coming around the 3,600 mark, or maybe between 3,200 to 3,400. The question is, even if these bounces were to come, would they sustain? My view is that unless the markets clearly see a turnaround in the inflation story and the CPI numbers that come in, especially the broader CPI, which includes energy and food prices, and the PCI index, it is unlikely that the rebound could be sustaining, or rebound could be V-shaped. I should, however, point out that if you were to look at the bond markets in the last 2 days, both the 10-year and the 2-year treasury yields have come down from their highs. And the bond markets could be a precursor to what to expect in the future. This bear market and potential recessionary times were triggered or signaled in the bear market. And one of the areas where the early triggers or early signals will come from is likely again to be the bond markets. So we should watch out that space very, very carefully. The other markets where there might be some early clues are the crypto markets. Now, in the crypto markets, on both Bitcoin and Ethereum, the pressure continues. Bitcoin is around 21K at the time of recording this video, and Ethereum is around 1100K, or just below 1100 at the time of recording this podcast. So they continue to be under pressure, and there continues to be negative sentiment, a negative news cycle around cryptos. If you were to look at the 5-year Ethereum price market action, it seems that there might be some possibility of support. Ethereum is actually below its 2017 highs, with the current number of about 1100, and there could be some support around these numbers, around 1000 especially, which is a round number, and typically round numbers provide some support. It is, however, fair to say that if Ethereum were to go down below this, the next support is pretty low. So interesting times right now. Some possibility of bounces both in the broader markets and in the crypto markets. But it is unclear whether these will sustain. my view is that the markets are probably going to continue to be in a volatile state for the next 2 to 3 months' time because the Fed's credibility is at stake. Thank you. You can subscribe and follow me at my Twitter and Telegram channels, which are at one Raj Kamal. Thank you.